You see, when back in the day in the 1980s, when I was young like you, unbelievable as it might appear now because I'm 55, almost white-haired. But believe me when I tell you this, I was young once. So back in my day, the financial planning norm was that if you can save up liquid investments, I'm talking of fixed deposits, bonds, etc., liquid, not fixed investments. Liquid investments which equal 25 forward years of your survival expense based on today's expenditure levels and invested in a fixed deposit. And mind you, in those days, the fixed deposits yielded an interest rate of 15% per annum. Exactly right, 15% per annum. So the interest that you received on this 25 years of forward estimated expenditure would be enough to make you keep your home and hearth expenditure going, as well as take care of future inflation as well. This was my generation's lifestyle that we enjoyed. Unfortunately for your generation, we guys have printed so much currency, which means the national exchequer has incurred so much of debt. Remember, every currency note has the words, "I promise to pay the bearer." So every currency note is actually a promissory note of the government. So we printed so much currency and we've created so much of debt that the interest rates have come down because the government must reduce its borrowing cost. So today you're getting an FD interest rate of approximately 5%, where I received an FD interest rate of approximately 15%. So if I wanted to dream of retiring, I had to collect 25 forward years of savings in an FD at 15%. But since the interest is now 5%, which is 1/3, you guys must save a liquid investment equivalent of 75 years of forward investments, which means you will never retire. You will keep working till the last day of your life, otherwise inflation will impoverish you. Now, this is the challenge that is faced by the younger generation, and this is something that I teach in all the guest lectures wherever I'm called to give lectures. And I tell my students, please take your financial life seriously and start investing. Now, how much should you invest? When I address people who are under 40, I tell them, for you, the metric is a little different because you're in a stage where you're going to be productive financially a whole lot longer than a 50 or 60-year-old. So take the number 100, deduct your age from it, your current age, and deploy that much in riskier assets like equity. If you're 50 and above, take the number 75 and deduct your age and invest that percentage of your money in risky investments like equities. The reason why I differentiate between above 50 and below 50 is because as a guy who's 55 years old, I know my clock is ticking. I'm good to make commercial viability or profits for another 10, 12 years at best. A 25-year-old has, technically speaking, 40 years of earning ahead of him. So he can afford to take a little more risk. So by all means, invest in equities. How much should you invest? I told you 100 minus your current age. Whether you should wait to time the market or whether you should buy right now, I think the best way is to systematically invest every month in the market from your savings, pocket money, earnings, call it what you want. That way, believe me, over a 5-year period, even if the market was to decline from today's high to settle wherever it does, it will go up again. Over a 5-year period, waiting will not really save you too much money. Investments will compound your wealth. The faster you start, the wealthier you will be as compared to your friends who you eat and drink in the college canteen today, who does not take investments and finance very seriously.